Welcome back to History Class with Dr. W. As we continue our discussion of the early stages of the Great Depression, in this lecture we're going to talk a little bit more about the causes of the stock market crash and then the ways that the crash contributes to a broader decline in the economy and the onset of the Depression itself. In the previous lecture, we talked about some of the broad market conditions that contributed to the crash and decline in the stock market at the end of the 1920s. But there remains a lot of discussion and debate among historians as far as why exactly on October 24th and October 29th, why at that particular time did the market crash so precipitously? So we understand, broadly speaking, factors that led to some correction or some decline. But why did things happen exactly when and how they did? Well, again, a lot of this is really hard to pin down. There are a lot of different opinions and a lot of contributing causes that historians look at. But if you or I could identify exactly how and why and when the market is set to decline, we could all make a lot of money in the stock market. And if these things were easy, everyone would be doing it. So there's still some uncertainty about this, but I'll mention a few of what historians have pointed to as some of the immediate causes of the crash. Well, I mentioned briefly the actions of the Federal Reserve in the weeks and months leading up to the crash. Over the course of 1928 and 1929, the Federal Reserve had been doing what we call tightening the interest rates, which means raising them gradually, which would slow down borrowing. Between January 1928 and August 1929, the general interest rate increased from 3.5% to 6%. Now, if you're doing something like margin buying, so you're borrowing money from the bank to put it into the stock market, obviously, you're much more likely to do something like that if the interest rate is 3% than if it's 6%. If you're borrowing money to put it in the stock market and you're having to pay 6 or 7 or 8% on that loan, you'd better make some pretty good returns in the stock market just to cover that debt. So this is the idea, and it applies to home loans, to car loans, and any other kind of debt. The interest rate is going up, and so more people are kind of declining the opportunity to borrow money. Now, this is a gradual process, and so it's really hard to say that the Federal Reserve policies caused the crash. But it does seem that that 6% number in August of 1929 was kind of a tipping point, and that borrowing really slowed after that. Now, I've already talked about the inflated stock prices at that time. And again, hard to say on any particular day that this was the cause of prices going down. But in general terms, we would look at the market of the late 20s now and say that it was due for a correction. Prices were going to come down sometime, somehow. But as far as immediate causes of the crash, one of the things that historians have looked at is a number of foreign investors who were pulling out of the markets, and this process was accelerating in September. Now, some scholars say that these foreign investors were a little more savvy than American investors. They recognized a peak in the market and were starting to get out while they still could. In other instances, there were more direct causes. For instance, the case of Charles Hattrey in Great Britain. He was a major businessman in Great Britain, and a number of his businesses were starting to fail across the ocean. So he began to pull out some of his money from the American stock market that September. Now, he didn't single-handedly create the crash, but as he and some other investors began to sell off some of their holdings, that contributes to the market going down. Now, one of the other questions that historians have wrestled with is why the market didn't come back. There have been many, many instances throughout our history when the market had a bad day or a bad week or a bad month, and then fairly quickly stabilizes, recovers, and starts to come back. In 1929 and the months and years following, that wasn't the case. The market just kept going down. So why couldn't we recover and pull out of what started at the end of the 20s? Well, there are reasons for that as well. One of them being margin buying, which I've described a couple of different times. So what happens when you take out a loan and put it into the stock market, and then if those stocks start to go down, what happens is you might get from your bank, you might get what's known as a margin call. That is, the bank calls you up and says, look, the stock that you bought has gone down. We need our money back. And you really only have a couple of options. You either have to come up with the money somewhere, or you have to sell your stock, get whatever money might be left in there, and give that to the bank, and then work to come up with the rest of that loan. Well, obviously, as this is happening to tens of thousands of people all around the country, banks are forcing them to sell their stocks. That's only putting more pressure on the market to continue declining. In general terms, and it's a big simplification, but the market operates in terms of supply and demand. If more people are buying, prices are going up. If more people are selling, prices are going down. So the more people are being forced to sell to pay off their margin debts, the more the market continues to go down. Another factor was a series of investigations into the various trusts, holding companies, and businesses that, as I described briefly in the previous lecture, begin to reveal the real kind of emptiness and frothiness of the market prior to the crash. And with each of these investigations, it only contributes to the market going down more. We can also point to poor banking structures and little to no regulation of banks prior to the crash. Many banks became insolvent and failed as the sell-off accelerated. By 1932, 40% of all banks in the country were out of business. And at that time, banks operated essentially on a cash on hand, or perhaps gold on hand. And so as their shareholders or customers came in to pull the money out of the bank, if they didn't have the cash in the vault to cover it, they just had to close their doors. And so banks were closing rapidly during that time. And then there is also the psychology of the market, and this may be the biggest factor. Investors and the market overall begin to overreact and panic. Selling begets selling. More people selling just because they start to feel desperate and hopeless and feel like things are not going to come back. Even today, if any of you are involved in investing or know anyone involved in investing, it's very hard to resist these kind of emotional temptations to sell when things are getting bad and only buy when things are going great. And those are probably the reverse emotions than what we should have. But it certainly contributed to the sell-off after the initial crash. So as I mentioned, the stock market crash itself does not cause the Great Depression, and in some ways the stock market can operate a little bit independently of the overall economy. But they certainly come to be linked together at this time. So let me talk a little bit more about broader causes of the Great Depression, and the stock market itself, of course, contributed to this. So, causes of the Great Depression. One of them was maldistribution of income. Even at that time, there was a very elite, wealthy few that controlled much of the money in the country, and the masses who didn't have much. Now, by the end of the so-called Roaring Twenties, common people were doing a little bit better than they had been, but there was still this gross disparity in wealth between the elite few and the masses who really didn't have very much. We might also say there was overinvestment in stocks, and the precise number is unknown, but about 10% of Americans had money in the stock market. But as we look back, very few of those people could actually afford to have money in stocks. In other words, they didn't have that money to afford to lose. And so certainly when things started to go south with the stock market, many people lost more money than they could afford to lose. I've also mentioned the process of overproduction and underconsumption that contributes to the economic depression that sets in. We were producing products at an astounding level. But when you think about some of the signature products fueling the 1920s economy, automobiles, refrigerators, appliances, homes, big ticket items, how many of those things do you need? There gets to be a sense that you've already got your car. You've already got your refrigerator. And so sales begin to slow down by the late 1920s at just the same time that these companies are producing more product than ever. And eventually that relationship just tips into an unmanageable realm. We can also see that by the late 1920s, prices on many goods are getting to be too high compared to wages. And certainly as the Depression begins to set in, many businesses only make this worse because one of their first reactions as the economy slides is to cut wages, which would help to preserve their profits. But that obviously hurts average workers and consumers. In some ways, technology contributes to unemployment early in the years of the Great Depression. And we think of technology as a great thing, and in many ways it is. But as lots of processes can be done by robots or by machines, human beings sometimes are put out of work. And so that certainly plays a role. I've also already talked about the proliferation of holding companies and investment trusts, these kind of empty companies that fool many of us into buying their shares. And then there also were the high tariffs. Throughout the 1920s, the American policy was to preserve high tariffs, that is, put high taxes on import goods. And what that does by the late 1920s and as we head into the 30s is it really discourages buying foreign goods or investment in foreign products at just a time when we needed more competition, more kind of lower priced goods. The most notorious of these is the Hawley-Smoot tariff, which we'll talk about more a little bit later. This was enacted in 1930. And many historians point to this tariff as one of the major contributors to the Great Depression. Again, at just the time when we needed to kind of broaden and open up ourselves to more competition and lower priced goods, we implement the highest tariffs in our history, the Hawley-Smoot tariff. Foreign countries respond with higher tariffs on American goods, and people all over the world are basically buying less product. I've also already mentioned that farmers were already depressed. So much of the country, almost half of the country, making their living outdoors on farms or in these other kind of industries were already struggling. And that only gets worse as the Depression worsens. And then there is the cyclical nature of depression. And we're going to talk about Herbert Hoover and his presidency in the next couple of lectures. Hoover referenced frequently this idea that depressions happen. In fact, it seemed like we were in a series of cycles. Every 20 years or so, it looked like things went down and then they always corrected. It might be rough for a little while, but things always came back. There had been serious depressions, for instance, in 1873 and 1893, and those were always followed by a relatively speedy recovery. And so Hoover and many others expected the same in 1929. Things will get better essentially on their own. But they didn't get better on their own. This was one of many things that Hoover and others were wrong about at that time. This chart shows us the stock market in this era. And so you can see the peak reached there in September of 1929 and the crash immediately following. Here is a little bit of recovery in the immediate aftermath, but then it declines and declines and declines all the way until 1932 when it bottoms out. And all throughout this period, Hoover was making speeches, the worst is over, things will be getting better. And on any given day, it might be possible to believe that. But on the whole, things continued declining and declining and declining until 1932. And this chart shows the inverse of that same relationship. Here are the roaring 20s. This is unemployment. The roaring 20s when unemployment is very low and things are going well. And then we have the stock market crash and the economy beginning to plummet and unemployment soaring bottoming out in 1931 and 32 when unemployment is 25% or more in certain parts of the country. And then here is the New Deal as things begin to improve. We'll talk later about this little spike here. And some of you, I'm sure, know what comes after the Great Depression. This is World War II, when unemployment once again drops to negligible levels. But as you see on this chart, for essentially a decade, the country is mired in this Great Depression when unemployment is incredibly high and conditions around the country are unimaginably difficult. So in the next couple of lectures, we're going to talk about some of those factors. What was life like during the Great Depression? How bad did things get by 1932? And we'll talk about Herbert Hoover and his response or lack thereof to the worsening depression.